Good afternoon. We'll start the webinar in about 30 seconds time because I can see there's people still just coming out of the lobby and being admitted into the webinar. So we'll start in about 30 seconds time. Okay, we'll start in a few seconds time. I can see there's one person stuck in the lobby, but hopefully they'll dial back in. There's a message across the top of your screens letting you know that this webinar has been recorded. That is because people who didn't manage to get here on the day, who asked separately, we put the recording on YouTube for people to watch later. There'll be no recording of your video feeds or microphones. Your video feeds and microphones will remain switched off throughout the webinar. Good, we'll kick off now, thank you. So we're talking today in this webinar about exit options and whether you fully understand your exit options and the difference between them. The agenda is quite a short agenda. We've got quite a bit to say, but we will finish within about an hour and we will allow time for questions at the end of the webinar. So we're going to start by just talking a bit about us, about strategic corporate finance and why we're qualified to talk about exit options, what we do and what gives us the experience to advise clients on their exit options and taking them through transactions. We'll then talk about your exit options and typical exit options, and Greg will take us through this section, an overview, and then Greg will talk about two of the most common exit options, a trade sale versus a management buyout. He'll talk about those and compare and contrast them. And towards the end, we'll do a short section on how we can help you meet your aspirations, help you achieve your exit, or if you are looking to do a management buyout or an acquisition, how we can help you with that process. And at the end, we'll do some questions. Please ask questions at any time you wish to throughout the webinar. We'll pick up on the questions and answer at the end. You ask questions by using the speech bubble that's on your menu. There may be no menu showing on your screen. You might have to move your mouse or your cursor up and down the screen for the menu to appear. But once the menu appears, the speech bubble is about a third from the right-hand side. Depending on how you're watching this and whether you're using the Teams desktop client, the speech bubble may be in a different place, but please ask questions at any time using that speech bubble. So I'm going to start by talking a bit about ourselves and why we're qualified and what our experience is to talk about exit options. We've been working, we're a small team, professional deal makers. We've been working full time. Strategic corporate finance has been going well over 20 years. And we advise full-time on transactional work. We do quite a lot of early stage advice in terms of guiding clients as to what likely valuation they will achieve, assessing different exit options, and really giving them the benefit of our experience and research we do into trade buyer activity to guide them and give them clarity as to what their viable exit options are and what their exit options are likely to look like in terms of valuation, how much cash they'll receive up front, whether there'll be a lot of buyer appetite for their business or whether there'll be issues that put off buyers, or whether alternatively a management buyout would be a better option and what sort of funding would be available, how much would need to be on deferred terms. So the early stage advice is really about giving clarity to clients who typically only go through a transaction once in their life, clarity as to what the transaction will look like and what can be achieved so that they can embark on that transaction at the appropriate time, knowing where it's going to take them, not with false aspirations. We do a lot of, if we're doing a trade sale, we do a lot of research to find potential buyers, and we'll always look worldwide. We use subscription databases. They're fantastic tools that allow us to find buyers worldwide. And similarly, the same tools can be used for corporate clients looking to find acquisitions, where they've looked at acquisitions that become available, businesses for sale, but they want to search more widely and approach businesses that are not necessarily for sale yet. We've got a lot of experience in management buyouts. I'll come on in a minute to show some thumbnail images of some of the trade sales we've done, some of the management buyouts we've done. But roughly, we're split 50-50 when we're acting for vendors. Roughly 50% of the time we do a trade sale. That's the right exit option for that client. And roughly 50% of the time we take the client and the management team through a management buyout. So we've got roughly equal experience of trade sales and management buyouts, which means we're well placed to be able to advise clients, having spoken to them and having understood their business in detail as to what may be the right exit option for them. As I said earlier, a lot of experience of fundraising for buyouts and acquisitions. And really, we're here to get it over the line, not at any cost, not the wrong deal for the client, but where the terms are right, it's the right deal for the client to help them get it over the line. We've been going, we're in our 22nd year. There's pictures of the three speakers today on the screen, Andrew, Greg, and Catherine. And we see our strengths as our experience, our determination really in getting deals away, integrity. We're a small team. There's very low risk confidentiality because we're a small team, not part of a large office where many people know you're acting on a deal. So confidentiality is really important throughout the process. And it's a personal, independent service. We're independent, and we enjoy doing what we do. We enjoy helping clients meet their aspirations. So looking at some of the trade sales, some of these are corporate acquisitions between corporates. Many of these are trade sales. The same pictures appear on our website, and you can click on any of the pictures on the website and I'll tell you a bit more about those deals. But experience in many different sectors, businesses of different sizes. Quite a few of those had international offers, and a few of them are international deals. And then management buyouts, a similar number of management buyouts, again, across a range of different sectors and businesses of different sizes. But really our typical deal size are businesses in the SME sector, businesses typically with only a few shareholders, and typically with turnovers between £2 million and £20 million. We do deals outside that turnover range. We'll do some smaller ones, we'll do some larger ones, but many of our deals have turnovers of sort of 3, 4, 5, 6, 7, £8 million. So I'm going to hand over to Greg at this stage, who will take us through the rest of the presentation until I join at the end to talk about how we can help. And as I say, there's questions at the end, so please feel free at any time to ask a question using the speech bubble. Thank you. Thanks, Greg.
Thanks for that introduction, Andrew. Hi, everyone. So yeah, I'm going to talk through the different exit options available to business owners for the next sort of 20 or 30 minutes. I've noted on the first slide 6 of the sort of most common exit options available, being trade sale and management buyout, which I'm going to concentrate on during this webinar and go into a bit more detail. Those are the transactions that we most often advise on in our work. The other options noted on that slide are the institutional buyout or IBO. This is a transaction where a private equity fund takes a majority shareholding in a company, and I'll talk more about that in a moment. You've also got the management buy-in or MBI, and this is quite a similar transaction to a management buyout. The difference being that the management team taking over the business are new to the company and are coming into the business to take it over, rather than a management buyout. It's the incumbents, the existing management team who are taking over the business. Again, I'll talk about that in a bit more detail in a moment. You've also got the employee buyouts, which is becoming more popular in the last year or so, partly driven by tax changes. And again, I'll talk about a bit more about that shortly. And then the final option on that slide is winding up, and this is more of a last resort really, and something that we rarely come across in our role as advisors. But sometimes the best option for business owners when it comes to exiting is simply to cease the business and collect in the value of the assets on the balance sheet. So I'm going to talk more about those different options in a moment, and we'll see that the best sort of exit option really depends upon what the shareholders want to achieve from their exits, what the circumstances in that particular company are, and different exit options will give a very different outcome and involve a different process. So first of all, just to sort of touch on the trade sale option in a bit more detail. So fairly obviously, this is a sale to another company, and usually that other company is in the same sector. It might be a competitor, or it might just be a business that has a complementary service or product offering, or a supplier or a customer. With a trade sale, it's usually possible for the owners of the business to have a relatively sort of clean break, which is sometimes what they want to achieve after giving a short handover period to the new owner. But that depends on how closely or how sort of hands-on the owners are in terms of running the business, and also what the buyer wants. A trade sale, very often leads to changes in the business, and they may only be fairly sort of small changes, or it could be quite sort of extensive changes where the business is practically absorbed into the buyer's own business, and ceases to sort of be its own distinct entity any longer. And again, that's one of the sort of key differences between a trade sale and some of the other options, such as management buyout, which we'll talk a bit more about shortly. With a trade sale, it's usually possible to receive most of the sale consideration in cash at completion of the transaction. And again, this is one of the sort of key distinguishing factors between a trade sale and a management buyout or other options. And again, if the owners of a business are looking to realize their investment and turn it into cash as quickly as possible, that may lead them towards the trade sale as the most appropriate exit option. But one of the drawbacks with a trade sale is that it can be quite an uncertain process and take quite a long time to get to the end results. And again, it depends on the circumstances of the company in question. If it's a company that is attractive to a number of different buyers, and there aren't any sort of major risks in the business that would put off buyers, then a trade sale can be sort of achieved in a relatively sort of fast timescale. But on the other hand, we often act for clients where there are issues in the business that would make a trade sale difficult. For instance, if there's a high degree of customer concentration, that would be a major risk for a new owner. In those sorts of situations, it can take longer to find a buyer, and there's more uncertainty over what the price would be and what the terms would be for the deal. So those are a few of the things to think about when it comes to a trade sale. Moving on to the management buyout option. Again, fairly obviously, this is a sale to the business's management team. But it doesn't, I use the word team. It might not necessarily be a team. It could be one manager within the business that takes over ownership. And the management team could include the sellers as well. Quite often we come across situations where the owners of a business go from having a 100% shareholding down to 25% or less, and the management team take a controlling shareholding, but the former owners retain a small shareholding and remain involved in the management of that business going forward. With a management buyout, contrasting with a trade sale, it is very much a case of business as usual. You've got some succession of management, and they might have some slightly different ideas in terms of which direction to take the business in, and make some small changes to how the business operates. But largely, the business will continue running as normal. There will be a new holding company set up to affect the management buyouts, but as far as the business's customers are concerned, and suppliers and staff, nothing changes. The bank details remain the same. VAT registration stays the same. It's very much business as usual. I've mentioned on the previous slide that with a trade sale, there's usually an opportunity to realise almost all the sale consideration in cash at completion. That is quite distinct to most management buyouts, where there's usually a significant amount of deferred consideration paid following the share transaction, usually over a number of years, and that's because with a management buyout, the consideration is funded through the business itself, through the business taking on bank loans, maybe using surplus cash on the balance sheet to help fund the deal value, and usually there is a gap between what the business is worth and how much money can be raised at completion, and then that gap is paid from the future profits and cash flows of the business over a period of time. So there is a requirement from the owners to essentially sort of funds the transaction themselves to a degree, and sometimes that's fine. Sometimes business owners, they just want to have their investment turned into cash as quickly as possible, and that can lead them towards the trade sale option. Another difference with a management buyout is that the process can be a lot easier to control compared to a trade sale. Part of that is because there's no need to go out and find a buyer for the business. The management team are already in place, and it's possible to have a valuation of the business done right at the outset before any negotiations have taken place between the owners and the management team. If the owners are happy with that valuation, it's usually quite a kind of a painless sort of a process to go from agreeing terms to a deal, and then through a fundraising exercise, and then through to completion of a transaction. And I'll talk more about that shortly. The third option is the institutional buyout, which is the sale to a private equity fund. So this has some sort of features in common with a trade sale, in that there's a need to market the business and go out and find a buyer. This can be done at the same time as the trade sale process, so you don't necessarily have to decide on an institutional buyout or a trade sale. If it's appropriate to look for an institutional buyer, that can be done at the same time as looking for possible trade buyers. Depending on how the business is managed, it could be an opportunity to have a clean break. So if the owners of the business have a management team in place and aren't needed to help run that business, then an institutional buyout gives an opportunity for them to have a clean break and exit after a short handover. If the owners of the business are heavily involved in managing it, then an institutional buyout can give an opportunity to de-risk, so to sell some of their shares, but keep some shares and work with the private equity owner to grow the business over a number of years before selling out completely. And this is a transaction we took a client through a couple of years ago, where the owners were fairly young, weren't in a position where they wanted to retire. But the business had a significant value, so it made sense to de-risk their personal situation by selling a majority stake, realising a capital gain, banking several £1 million, but then retaining a significant equity stake in the business, and then committing to manage the business for a 5-year period with the new private equity owner, and then look to sell their remaining shares after that period of time. So an institutional buyout isn't appropriate for every business. It does require businesses to have a good level of growth potential and a solid business plan, demonstrating to private equity investors the growth prospects of the business, what the management team are doing to achieve that growth, what further investment would be needed, what the exit strategy would be in the medium term, in 3 to 5 years, how the private equity investor is going to make their required return on their investment. So that can be for the right business, that can be an exciting exit option. You've got the management buy-in exit option as well. So as I mentioned before, this is slightly different to a management buyout in that you're selling the business to an incoming manager or incoming management team. They're quite often in this situation, the incoming managers may have worked at a similar business during their career, may have been a salaried director for a large corporate business and taken the decision that they want to buy into their own business and work for themselves. Management buy-in transactions usually enable the sellers to have a clean break once they've sold their shares, provide a short handover period to the incoming management team, and then usually exit from the business fairly quickly. Management buy-in deals, in my experience, they always give the business a sort of more impetus. Quite often we find when we're working with clients, they might be the founders of a business and have worked in it for many decades, and have just reached a point where they've grown the business to the point that they're comfortable with. It's making them a good living, and really sort of the business is sort of plateaued at the point where they're then looking to sell and usually retire. With a management buy-in transaction, the incoming management team will usually have lots of their own ideas, lots of energy, and make changes to the business with the aim of growing it significantly in order to make a return on their investments. And as I mentioned, in almost all cases where I've been involved, there's been a very positive impact on the business following that transaction. In terms of how management buy-in transactions are structured, it is very similar to the management buyouts in that it's the business that's funding the deal rather than the individuals in the management team. And for that reason, there's usually a need for a significant amount of deferred consideration to be paid to the sellers over a number of years. And again, if that's sometimes a sticking point for sellers if they do want to realise all of their cash at the point they sell their shares. But sometimes it is necessary to go down that route. Management buy-ins are particularly suitable for businesses where for smaller businesses, and we call these subscale businesses, where they're perhaps not large enough to attract the interest of trade buyers, and because of their small size, they're less likely to have the existing management structure necessary to go down the management buyout route. So it could be a smaller business where the owners are actively involved in running the business, and because there's that sort of lack of management capacity in the business, that there can be the management buy-in can be a good option in those situations. As I mentioned at the start, employee buyouts have become more popular in the last year or so, and these are transactions where a majority ownership stake is sold to the employees of the company, and usually it's the employees aren't directly taking shareholdings, but they're sort of indirectly taking ownership through an employee benefit trust. The government sort of sanctioned scheme, employee ownership trusts, these feature some quite sort of attractive tax breaks for sellers to go down this route, and these tax breaks include a 0% capital gains tax rate for selling a majority shareholding in a company, and that tax advantage is becoming more important recently because of the changes to entrepreneurs relief, now renamed business asset transfer relief. Because a couple of years ago, you could realise a capital gain of £10 million and pay 10% tax under entrepreneurs relief. That's now reduced to only £1 million of capital gain, and then above that, you're into the 20% capital gains tax bracket. There is sort of an expectation that the Chancellor will make further sort of increases to capital gains tax for business owners, possibly at the next budget. And for that reason, the attractiveness of the employee ownership trust exit route is increasing. So there are some tax benefits subject to structuring the transaction properly. Similar to a management buyout in terms of how they're funded, it's the business that's going to be paying for the shares ultimately by making contributions to the employee benefit trust to then pay the former shareholders for their shares. So it's very likely there'll be a substantial amount of deferred consideration featuring in these deal structures. The employee ownership trust must apply the benefits fairly to all employees. It can distinguish between different categories of employees based on remuneration or length of service. But one of the key sort of criteria in order to get the tax benefits is that all employees must be treated fairly. And one of the things to think about is that it's likely that the future employees of the company and the younger employees are more likely to benefit financially from an employee buyout rather than older, longer serving employees. And that's simply because it's likely that the profits and cash flows of the business over a number of years are going to be used to repay the shareholders for their shares, and therefore there'll be less money left in the company to pay out any bonuses. So it doesn't automatically follow that going down the employee buyout route means that you will be financially rewarding your sort of long-serving employees. It could be that the employees that you intended to benefit from this end up retiring and leaving the company before there's any sort of financial benefit to them. But an employee buyout, similar to the management buyout, means that it's business as usual. There's no sort of changes to the business that would be necessary. And one of the other sort of possible advantages is that there's no need for there to be a sort of change in management at the point the shares are sold to an employee benefit trust. If the owners are actively involved in running the business day to day, they can continue to do that the day after they've sold their shares to the trust, and there can be a very sort of gradual change in the management of the business over a number of years as people are trained up or new people are recruited into the business to take over from the sellers. So that's something that it is more popular at the moment and is worth looking at in some circumstances. So that's an overview of the main sort of different types of exit options available. I'm now going to just go into a bit more detail, looking at the two main options being trade sale and management buyout. I'm going to look at what kind of valuation can be achieved in those sort of with those different types of transactions, the process that's involved, the impact on the business in terms of continuity, how they're funded, and I'll touch on confidentiality as well. So firstly, looking at valuation, there's a sort of a common perception that a trade sale will always sort of deliver a higher value than a management buyout, and it's logical to think like that because trade buyers will have deeper pockets and be able to benefit from cross-selling opportunities or cost savings, and therefore ought to be able to pay a higher price. What we found is that in most situations we come across with the types of clients we deal with, is that a management buyout it's usually possible to structure a deal with a higher value than what you might expect to receive from a trade sale, and that's largely down to how the deal is funded and the risk that the risk profile for a trade buyer compared to a management team. So if you're looking at a transaction from the point of view of a trade buyer, you might be paying £1 million for a business, and your risk is that £1 million. If anything goes wrong, that's the money you've invested, and therefore it's very important to evaluate the risks, do very sort of thorough due diligence, and make sure that nothing's going to happen to that business that's going to cause the value of the business to drop after you've taken over. If you're looking at it from the point of view of a management team, the amount of risk they're taking is really limited to the personal contribution that they're making from their own pocket, which might only be a few £1,000s as a sort of a token gesture almost. The deal is largely funded by the business itself, and therefore the risk for the managers is very, very small. And it's really that risk means that the management team can afford to pay perhaps a slightly higher valuation than a trade buyer would. The process is quite different between a trade sale and a management buyout. With a management buyout, as I've mentioned, that there's no need for a marketing process to go out and find a buyer. So immediately you've sort of saved some sort of a lot of time and effort and money by avoiding that marketing process. On the other hand, with a management buyout, there's usually a need to go and raise some funding from a bank or other lenders as part of the transaction, and therefore there is a need to prepare, usually a need to prepare a business plan and forecasts, and go and talk to a selection of funders. So there is a bit of a time requirement there. With the trade sale, when we're acting for clients, we'll advise them at the outset as to what the likelihood of finding a buyer, and what the likely valuation is going to be, how offers might be structured. So we always advise clients at the outset, so there's no surprises later on. However, you never really know how things are going to turn out until you actually get into the process, and sometimes you can find a deal faster than expected. Sometimes it takes a lot longer. So there is a need to sort of be patient with a trade sale process, whereas with a management buyout you can be much more sort of prescriptive about how long it's going to take. Once you've agreed a deal in principle between the shareholders and the management team, it's usually you can normally sort of set a timescale in months and be fairly confident it will complete, but by a certain date. The due diligence process is usually easier with the management buyouts, as the managers have a lot of knowledge about the business already. There might be some areas that they'll want due diligence to be conducted, for instance, if they've not been involved in the tax affairs of the business. They might want their accountants to have a look at that. But in terms of the commercial operations of the business, it's unlikely the management team are going to be asking too many questions. Contrast that with most trade buyers, as I've mentioned, they're taking a lot of risk in writing a big check. They've got a starting point of not knowing anything about the company, and therefore the due diligence they're undertaking is going to be much more extensive and time consuming and costly to deal with from the point of view of the seller. And the legal negotiations at the back end of the process, once the solicitors are involved, it's likely that those negotiations will be less fraught with a management team compared to a trade buyer. There's still going to be the same warranties and indemnities needed, but again, the management team are starting off from a point of they know a lot about the business, and therefore they're not going to be pushing so hard when it comes to negotiation of the legal documents. I've mentioned business continuity a couple of times already, and it is very different between a trade sale and a management buyout. One of the things that often puts clients off the idea of a trade sale is the fact that the incoming buyer might make quite significant changes to the business. It might be absorbed into a larger group. They might change the organizational structure of the business, change the terms with customers, and all those things. Can be a worry for clients when they're looking to sell, and it can be more attractive to look at the management buyouts where they know the management team already, and that they're comfortable with the which direction the management team wants to take the business in going forward. And again, it's possible for the owners to stay involved with the business in a non-exec capacity, and maybe with a minority shareholding, and just sort of help guide the management team going forward, and remain involved with the business. But in some circumstances, it might be the best thing for the company to sort of become part of a larger group and unlock growth potential in the business. It might be a company where, for instance, we advised a software company quite a few years ago where it had a good product, but didn't have the sales and marketing resource in the company to effectively sell that product in the market. So it made sense to sell to a trade buyer, become part of a larger group, and allow that group and its sales and marketing channels to sell more of the software products that our client's company had developed. So it depends on the company and the objectives of the owners. I've talked about funding already, but just to sort of expand on that, with a trade buyer, it's their responsibility to fund the deal, and in most cases that's a good thing from the point of view of the seller, but you do have to be sort of slightly careful that the buyer that you've agreed a deal with can afford the acquisition, and there's not going to be any issues if they need to go out and raise funding themselves to complete the deal. With the management buyouts, it's the management team would sort of take responsibility for raising the funding. Usually when we are advising sellers on a management buyout, we would also take responsibility for the fundraising, so that risk is taken away. So sometimes it can be an issue if there's a management buyout has been agreed, and then the owners have sort of left it to the management team to go out and speak to banks and raise funding for a deal. So what we like to do for clients is take responsibility for not just structuring the deal, but also the fundraising, and therefore the sellers are more in control, and there's less risk that a deal is going to fall over because the management team aren't able to raise the necessary funds. I've noted on this slide that the management team would need to invest some of their own money, and how much depends on the circumstances of the company and the deal. And if it's a larger management buyout where there's millions of pounds being lent by a bank or a private equity fund, then it's very likely that the bank and other funders would require a significant personal equity investment from the managers as well. If it's a smaller transaction that's maybe just reliant on asset-based lending, then the amount of equity can be a very small amount indeed. So as I mentioned, the exiting shareholders with a management buyout are likely to need to sort of support, help fund the deal by accepting a significant amount of the consideration on deferred terms. And whilst that's generally a negative aspect of management buyouts, there is a silver lining in that there's an opportunity for exiting shareholders to get a high level of return on that money that they've effectively lent to the management team to help them fund the deal. So it could be charging an amount of interest on the deferred consideration, or as well as that, it could be taking a retained shareholding in the new holding company and then selling that shareholding in a few years' time. And through doing that, the exiting shareholders can receive some of their money up front at the point they sell the shares, but then get an above market level of return on the money that they've left in. And sometimes that can be an attractive feature for shareholders if they've got that confidence in the business that they're definitely going to get that money. They might not need it straight away. They're happy to wait a few years until they get it, and they can get a good rate of return on that money in the meantime. But obviously, in some situations, it's better to go down the trade sale route and look to get all of your cash or most of it at completion. And finally, the final point to mention is confidentiality. And this is always an important sort of aspect of transactions for clients. There's normally a desire to keep these things under wraps, and it's far easier to do that with a management buyout compared to a trade sale process. With a management buyout, everything's kept in house. You're only really talking to the managers, professional advisors, bankers, etc. And then even if there is a sort of a breach of confidentiality, it's not as big of an issue if staff or customers find out that a management buyout process is going on in the background, because it's unlikely there's going to be any sort of serious significant changes to the business once that transaction happens. Contrast that with a trade sale. If staff or competitors or customers find out through industry gossip that a company is going to be sold to another company, then that can be quite a sort of a serious issue to deal with. And also, as I mentioned, sometimes with the trade sale, it is a deal between two competitors, and the issue of releasing sort of potentially sensitive information to another company that could be used against them can be difficult. With the management buyouts, you don't have that particular issue. So just to wrap up on what I've talked about, the best sort of situations for a trade sale tend to be where the owners of a business want to have a clean break, want to maximise how much cash they receive at completion of a deal. in situations where the management of a company don't have that aspiration to sort of take over the business and become the owners. If there's a good level of deal activity in a particular sector, then that could lead you towards the trade sale route rather than a management buyout. And the level of business risk in a particular company has a bearing. If it's a business where it is highly dependent on one or two key individuals or one or two key customers, or there's no visibility over future revenues, those sorts of key sort of risks would put off most trade buyers and make a management buyout a better alternative. And situations where management buyout might be best, where you've got owners wanting to remain involved in the business beyond the point they sort of sell their shares. With a management buyout, you've got an opportunity to sort of create a bespoke deal to suit the needs of the shareholders. You could have them drop down to a minority shareholding and then move into a chairperson role for a number of years and still remain involved with the business. Where you've got a good management team, obviously, who want to take the business forward, that helps. As I've talked about, where you've got situations where the owners are happy to sort of be patient and get paid over a number of years and get a continuing return on their money. And as I've mentioned, where there's commercial risks that would otherwise put off trade buyers. So just to conclude, there are many different options when it comes to selling your company. It's important to have a clear understanding about what those options are, and Andrew will talk a bit more in a moment about how we can help with that. Each company and situation is different, so it's difficult to you can't simply say this option is better than that option. It depends on the circumstances. There's many aspects of a sale other than valuation that are important. One word that crops up very regularly is legacy. So it's not just how much cash is being paid at the point the shareholders exit. It's also what legacy they're leaving behind, and those sorts of soft issues can lead you towards the management buyout or employee buyout possibly. Trade sale doesn't always give the best result, so just be aware of bias from who you talk to. There might be some business brokers who obviously their business model is purely to look for trade buyers and therefore wouldn't sort of look to steer people down different exit options. So it is important to speak to your advisors and make sure you understand all the different options, not just the trade sale. And I'll hand back to Andrew at this point, who will talk you through how we can help, and then we'll move on to any questions.
Thanks, Greg. Just a very quick couple of minutes on how we can help, and then we'll go on to the questions. Can I remind you, I think we've had 2 questions so far, but can I remind, if you want to ask a question, you might have to move your cursor or mouse up and down the screen for the menu to appear, and then use the speech bubble just to ask the question, and we'll pick up on the questions in a couple of minutes' time. Just how we can help. We welcome the opportunity to talk to any of you who've attended the webinar this afternoon. We've spoken in general terms this afternoon, but we'd really welcome the opportunity to be able to understand your business, understand your aspirations, and how we can help you. As I said right at the start, we believe in giving a lot of early stage advice, and the early stage advice often involves a detailed valuation report, and often involves a feasibility review. Whether that is a trade sale feasibility review, where we look at deal activity in your sector, looking worldwide, not just in the UK, thinking about any issues that may make it difficult to sell your business, or whether it's the MBO feasibility, where we're thinking about, again, valuation again, what can be achieved, what can be funded, how much would have to be on deferred terms, how would we structure the deal, how much management equity would be required, Have you got the right people to make it work? But the early stage advice is important. For some clients, we meet, they've decided on their exit options, they've decided appropriate exit options, but for others, a trade sale may be the exit option, but they want to understand that in more detail. Others, it's the management buyout. Occasionally, there's a genuine choice between a trade sale and a management buyout, and occasionally employee share ownership arrangements. So we welcome the opportunity to get involved at an early stage. When you take a decision to proceed with your exit, you're taking a decision based on an informed choice, understanding where it's likely to take you. Our main service is lead deal advisory. So once you've decided you're going to go through an exit, whether that's a trade sale, management buyout or otherwise, helping you achieve that, taking you from start to finish, doing the heavy lifting as we go through the process, managing the process, working closely with your solicitors, working closely with your accountants. Dealing with issues as they happen, but we prefer to actually predict issues that are likely to occur, so we've dealt with them before they become issues, and making the deal happen, not, as I said at the start, not at any cost, but making the deal happen where it's right for you. Welcome the opportunity to be able to speak to any of you, and Catherine will be emailing out the slides after this presentation over the next couple of days, and offering an opportunity to have initially a chat online using Teams or Zoom. Welcome that opportunity. So we're going to move on to questions at this stage, and Greg's going to come back on and Catherine's going to join us. There's still an opportunity to ask questions. If you just use the speech bubble, ask a question, we'll try and pick up on all the questions that are asked. So Catherine, over to you, just coming back on, over to you. What questions have we had so far, Catherine?
Great, thanks, Andrew. The first one mentioned the capital gains tax increases earlier, and the question is the time to complete a sale before the capital gains tax changes come in?
I think, shall I take this one, Greg?
Yep, go on.
We're anticipating capital gains tax increases, and I think they're widely anticipated because the current Chancellor of the Exchequer asked the Office for Tax Simplification to do a review of the capital gains tax regime, and they reported last November, and their report is in the public domain, and they were looking at all sorts of different issues, including capital gains tax rates. There's clearly a massive difference between for a lot of businesses we sell, they've got mountains of cash on the balance sheet, and the mountains are there because the shareholders have stopped taking dividends because of the very high tax rates on dividends, the income tax rates, and have been advised to just let the mountain of cash accumulate because they can get that cash out, or could get that cash out at 10% tax rates and entrepreneurs relief. We've seen entrepreneurs relief drop under this government from £10 million lifetime limit to £1 million lifetime limit. But even so, those who've used the £1 million, they're paying 20% tax rather than higher rates of income tax on dividends. The discussion paper from the Office of Tax Simplification was looking at these issues, looking at whether entrepreneurs relief should be widely available or should be linked to retirement age, and just looking at the whole capital gains tax regime, even looking at the annual capital gains tax allowance and whether that should continue. So we believe changes are coming. The other clue we've got that changes are coming is that the budget in March, they published the Budget Red Book on the day of the budget, and that is forecasting capital gains tax receipts to increase by over 50% over the next 3 years. So we're expecting the regime we've had for most of our clients for many, many years is pay 10% tax on exit, stop taking dividends, let the cash accumulate and get that out at 10% tax as well. We're now expecting much higher capital gains tax rates. So that's the background. I don't think the government has officially confirmed when the next budget will be, and they had moved to October budgets, but the last two budgets were in March. I think the consensus view is the next budget is probably going to be in March to allow the economy to recover a bit from COVID. And that gives plenty of time to get a transaction away if you start taking advice very quickly. When I say plenty of time, you'll get a transaction away by March if you talk to us or whoever is going to advise you very quickly, and we get on the process where you'll get the transaction away. We were expecting these changes in the last budget, and we completed 3 deals in the 7 days up to the last budget date. Really managing to complete deals at an accelerated pace to get them away before the budget because of these potential changes. So I think the simple, I've given a long answer, but the simple answer is yes, if you're quick. Catherine.
Okay, yeah, thanks, Andrew. Right, the next question that's come in is about company valuation, and it's what's the best method for valuing a company that's going to be bought by a trade buyer?
So I take that, Greg. Do you want to tell me? It depends.
I'll attempt it, Andrew. So yeah, it's quite a big question that. So I mean, we do actually have a separate webinar on company valuations where we'll sort of talk through how we go about valuing businesses. For most businesses, it's an earnings-based approach, looking at the underlying maintainable profits of a business. Establishing what an earnings multiple should be for that particular business based on its risk profile and growth prospects, and then adjusting that figure for any surplus assets or debts on the balance sheet. Whether a trade buyer might pay more than that valuation depends on the circumstances. So trade buyers, if they can knock out a significant level of the overheads of a target business, they may be willing to pay a higher valuation as the profits would be expected to increase. But it really depends on the circumstances, what the sort of negotiating position is of both sides. So it's difficult to say with certainty what a particular trade buyer might pay for a business.
I mean, what we try to do when we do full marketing of a business and we do buyer research, we're looking to do a lot of research to find buyers who will get more value out of the business than if it remains independent and standalone because of what they bring to the party, being it more substantial sales and marketing channels and distribution, or whether it's manufacturing efficiencies or whatever it is. We sit down with clients where we're doing the full marketing exercise and aim to identify what the attributes are for the ideal purchaser, looking for purchasers who can make more profit out of the business than our clients can, and therefore the business has more value to that purchaser than it does to our clients. Getting them to then pay that extra value is the trick, really, and they see that as part of what they're bringing. It's their value, it's what they're creating. But to get the deal away, they will have to often pay some of that value. There's different ways of valuing businesses, and there's all sorts of discussions in the detail. It's not just about the underlying methodology, it's about the detail. And Greg's talked about some of the cash-free and debt-free adjustments can make a winning arguments on certain fundamentals, can make a fairly significant difference to the valuation at the end of the day. So it depends, and we really like to understand businesses in detail and understand the attributes of those businesses and how they'll be attractive to purchasers to be able to help get the best value possible. Catherine.
That's great. Thanks, Andrew. That's all for questions for now.
Okay. We did say we finish at 3 o'clock and it's 1 minute to 3. So thank you for listening. As I say, Catherine will email out the slides and offer you an opportunity to have a chat to one of us over the next 2 or 3 weeks. If you'd like that, we'd welcome the opportunity to talk to you. Thank you very much for listening today, and I'm going to end the webinar at this point. Thank you very much.